So let's go to that question of how private equity gets into 401ks. Does it have to be through some kind of closed-end fund vehicle? Is that what all these firms are going to set up? And then I guess as a corollary question, the cynic in me thinks when they come for our money, it's not because they're helping us, it's because they need our money, because the institutional market is close to tapped out, and so they need another source of growth. And do you think that's fair? How much of this push into the retail market, especially on the part of big PE firms, is because they're doing us an enormous favor and helping us all get rich and save for our retirement? And how much is it because they're at this place in the previous business model where they need fresh money?
Yeah, well, I think as Luigi described, I mean, the college endowments were the original buyers, are stuffed to the gills with this stuff already. They want less of it, not more. Private equity has been bailed out by interest from the Middle East, which has bought a lot of if you went through some of these large private equity firms and asked what percent of their investors from the Middle East, it's a shockingly high percentage. So they've been sort of that customer group has replaced the college endowments. How long will it be till all the sheikhs are stuffed to the gills with private equity and don't want any more? I don't know, but we're probably pretty close to that. And then they need a new market for growth, and that's largely retail. Oh, by the way, insurance was another one. Buying insurance firms or getting insurance assets invested in private equity or private credit, that was a big growth area as well. Now that's sort of tapped out, and so the next venue is private is retail. And now they've been going to retail through things like iCapital for years. So I tend to think that all of the sort of quote unquote sophisticated high end multifamily offices and those sorts of things, anyone that wanted private equity could get private equity. It's not been hard to access as a retail investor if you had a certain amount of assets and were with a certain tier of financial advisors. You could get it if you wanted it. Whether you wanted it, who knows? But it's been accessible. I think what they're now trying to do is essentially create vehicles that are even more accessible, which means this sort of closed-end fund structure where it's going to be able to be traded on a daily or monthly basis and stuffed into the 401k plans. And I think that's a rather worrisome development. I think in part, I think we have to think about fees. Fees matter. Alphas are scarce. Fees are certain. How much alpha is there? And can 2 and 20 type fee structure, is that sort of surmountable in the private markets, and how are they going to surmount it? And by the way, it's not just going to be 2 and 20, because there are going to have to be some sort of feeder fund fees, and you have to remember their portfolio monitoring fees and all these other underlying fees. So private equity is an enormously high fee strategy. And I think that retail investors, thanks to John Bogle and Vanguard, have been well conditioned to understand the importance of low costs and to feel like they're being robbed every time their financial advisor proposes something very high fee. And so I do think that actually retail investors writ large are going to be fairly skeptical of private equity in their 401ks. I mean, I think that the sort of access pitch of, well, we do have unique access to this private equity vehicle has been a selling point to a certain set of wealthy people, but I'm just not sure it has mass market appeal. I think the optics of private equity for the average American are probably negative, and for the average investor that likes index funds, I just don't know how you're going to go from owning index funds to putting 20 or 30% of your money in a 4 or 5, 6, 7% fee load vehicle.
Bethany and I compete on who is most cynical. And in this case, I think I'm more cynical than her, because my big fear is not that George Mark, first of all, George Mark might not even have a 401k, but George Mark with a 401k will wake up in the morning and say, I want to invest in private equity. Unfortunately, he might say, I want to invest in cryptos, but that's a different story. So how do these people get to put private equity into their portfolio? I think that, there are a lot of various index like target retirement fund, opaque things that are market heavily by the various provider of the 401ks. And if the providers are paid enough, they're going to stuff this stuff without us knowing. And whether you believe in the past that private equity was good or bad is irrelevant at this point. This point is, is facing, in my view, a crisis in this moment, precisely because the expansion phase is finished. And you're right, it's not just the attack of Trump to university, but they went from 0 to 40%. They can't go above 40% even without Trump, okay? So
Yep.
the expansion phase is finished, and you run out of sheikhs to dump this stuff to. And who are the leftovers? Us. And it says, I think that this is the biggest bailout of Wall Street done by American taxpayers, certainly since the one in 2008, but probably more even historically.
Yeah, I think I think that's exactly right, and I think it's a very worrisome development. But I think that there are enough skeptical voices. I like to think the American people are more sort of diversity of opinion than your average university endowment staff. So I'm hopeful actually that that this push into retail will not go as well as private equity titans are expecting. But I do think you're right that they're going to try to stuff it into the target date funds, and they'll say, you know, the 2045, 2050 target date fund is going to have a 20% allocation to PE, and that'll scale back over time, and that's how they'll do it. They won't sort of, but I think to the extent that those funds do start trading in any sort of liquid way, the discounts are going to shock people because they're going to say, wait a second, why is that thing that I invested in at 100 cents in the dollar now trading at 80 cents in the dollar? And that's going to weigh on performance. And I think already, already you're seeing that endowments and foundations, the smaller endowments, which did not do as much private equity for a whole variety of reasons, are outperforming the larger endowments and have been for the last 3 to 5 years. And they're doing so because they have less private equity. Private equity is now a drag. It's a meaningful drag, just like hedge funds used to be on large endowments. And so I think selling people on an asset class that actually has bad trailing performance numbers or worse trailing performance number than the low fee index fund, I don't think that's that compelling.
Can you guys explain to me? I actually don't understand the concept of being able to stuff this into target date funds. Can someone explain that to me so that so that both I and all of our listeners know what to look out for?
Yeah, so I think the idea, so there are these target date funds, and essentially what they do is they say, you're going to retire in 2065. You put your money in this fund, and then we will manage all the underlying investments, and the asset allocation will change over time as you get older. And so it'll be a lot of equities early on, and there'll be a lot of bonds closer to 2065, and we're going to change it and adapt it. And so all you're going to see as a line item in your portfolio is like BlackRock 2065 retirement plan. Um, and I think that's where you could stuff a private equity fund in and nobody would notice because they don't see private equity as a line item in their portfolio. They just see a target date fund in their portfolio. And they don't know what's the underlying composition is. Um,
And
and actually,
who runs the big target date funds?
all the big asset managers have big target fund businesses. It's a very common way of providing retirement accounts or retirement vehicles.
Do the big Wall Street firms have big
Of
target?
course, Vanguard, BlackRock, everybody.
Goldman and Morgan Stanley and Merrill Lynch as well?
I imagine so. I don't know every single one, but
Okay. Because I think that's part of my fear of the corruption here is that, and I think it actually, when you mentioned the financial crisis, I started to think it actually is really interesting. So let me just lay something out and see what you guys both react to this. But, private equity has for years now been the biggest fee payer on Wall Street by far. And so all the Wall Street firms are incentivized to keep the private equity machine running in any which way they can because it's become a huge portion of their investment banking fees. And so you can already see it in the unwillingness of any Wall Street firms to ever criticize private equity or to issue sell reports on the publicly traded private equity firms. And so you can see that the Wall Street firms then will also be incentivized to try to keep this going in any way they can. And if they're the ones running the target date funds, then I can see that being an issue. And I can also see the collapse or any problems in the private equity industry actually becoming a larger problem for Wall Street in an interesting way because of how tight the linkages are now. What do you guys think of that? Is this me being a complete doomsayer?
I think there's a Chinese wall between the asset management and the banks, but the CEOs probably think that way.
Right.
But I think that, generally people know what's good for Wall Street, and private equity is very good for Wall Street. The more private equity, the better. And you just, I mean, I think of this like, you think of this as a constant war. Everyone wants to make money off your retirement savings, and like Jack Bogle, gosh, that guy just eliminated such a huge profit pool, right? I mean, just annihilated the active world, right? And so everyone's saying, well, how can we get some of that fee back? And like, why not private equity? Like, you don't need much private equity at 4, 5, 6% per year fees to get your entire thing back up to like what the active management total fee load was 20 years ago, right? Like, you can totally recover, if not more so, all the losses from indexing that have been inflicted on large asset managers if you can roll out private equity, right? It's such a fee generator.
Then every time I hear the word Chinese walls, I get allergic because, the Great Wall of China did not work. Why did not work in protecting against the invasions is because the Chinese generals from inside opened the door.
Right.
And so I think that there is a Freudian lapsus that everybody uses when they say there's a Chinese wall.
Yep.
Because you have this big construction that looks impenetrable, but eventually somebody always gets in. So I think that in this respect, I'm much more cynical than Bethany, but I am in a good mood today and I want to actually be positive. And the positive is the following. So you run a newsletter that pays attention to this thing. So I'm going to call upon you to, number one, call out all the sponsors that stuff this in the target funds. Okay, so that now I'm creating readers for your newsletters, because all the 401k holders will read your newsletter to know if your stuff is in it. And second, to be a sponsor of a fantastic class action suit.
I think there will be.
Because there will be a class action suit. So the only way to protect our 401ks is to have a bunch of lawyers ready to jump on any 401k administrator who lets this touch a target fund.
Yep. I like
it. Everybody, you are on warning. Somebody is paying attention. Anyway, Dan, thank you so much. As always,
my pleasure.
It's a total delight to talk to you. Thank you.
This was a lot of fun.